Welcome to the Broken Pie Chart Podcast, episode 385. I'm your host, Derek Moore. Back with me again, Mike Snyder and Shane Skinner. All right, let's talk about SpaceX. We're coming into 30 days, right before the IPO. All of us were talking about, do you remember when Tesla came out? I think Tesla was down quite a bit 30 days later. Google was the one that was up quite a bit later. And there's all these little things in between. Shane, we were just debating off air. Do you use the IPO price? So it comes out at 135. It's closed today at, what did it close today? 152.16. And that would be up 12.71% from the IPO price. You are suggesting, Shane, that we should use the 150, the first trade price, because that's the first price that you could actually have bought it in the secondary market when it actually started trading, if you didn't get IPO shares. And if you use that, it's up 1.4%. It hit a high of 201.80, and since then has come down. So when was the IPO date? That was the 11th of June, right?
I believe that was when the offer price was set, and then the IPO itself took place on the 12th. Yeah, and that's where, if you, like you said, if you had gotten in on the original IPO, I believe it was set at 135, but the open secondary market opened at 150. I think it saw a low that day of like 149.34. And yeah, I mean, it ran there the first 3 days, and since then it's fairly close to flat. I think we saw a low of like 145.20. I'm seeing here yesterday. So I mean, at one point this was down technically from where it opened.
It was down. Yeah, I mean it went up. I mean we had a close the 15th 192.50. So what's interesting now is I believe it has gone into the NASDAQ 100. Mike, is that right? I know you've been calling their offices daily, finding out when it's going in. You haven't been doing any of that, but
I have not, but I believe that's correct.
And that's the thing. Like everyone, July 7th. So that was we're recording this on a Thursday. That was Tuesday. So yeah, it goes in, and that was the hope. That was the hope. Everyone who held this said, they're going to buy this. It's going to be a massive buy. It's going to go up. I mean, who knows? It's like super early, but yeah, Mike, it's in the NASDAQ 100. So in theory, that index had to buy stock.
It had to buy stock. I mean, it's not a huge component at this point, right? It looks like it's about 1.25%. So it's not nothing, but it's not, NVIDIA or Apple based on the float. So yeah, I kind of look at it as, if you were able to get it at the IPO price, that's great, you're up. But if you've traded this, it's pretty much flat.
21st company. So I'm looking at QNDX. That's my cheat. That's the new NASDAQ 100 ETF. BlackRock also just, I think, released theirs or is in the process of doing that. And of course, the classic Qs, QQQ, But I'm looking at QNDX. Yeah, it's number 21, Space Exploration Technologies. 1.25% is what I see on Bloomberg as a member of that. To give you an idea, I mean, NVIDIA is the top dog there, and that's 7.9%. We covered this, that because the float on SpaceX is not 100%. So not all the shares are considered free float. And a lot of times indexes do some sort of a free float adjustment. I believe the NASDAQ is allowing some sort of a ratio. I think it's a few times what the actual float is. So one of the ways that you'll actually be able to see when the float increases, and this will be, let's say somebody it comes under the unlock and now they can trade their shares. One of the things I'll do is I'm going to build a chart in Bloomberg and chart the stock, but I'll also chart the free float in shares. And so as more unlocks happen, you would expect more free floating shares to be out there. So that will kind of be an interesting. I mean, the free float, 638.9 million out of 7.4 billion shares. So 7.4 billion shares outstanding, 638 million is the free float. So you can kind of do the math yourself. So, all right. I mean, congratulations. It made it into the NASDAQ 100. Normally it wouldn't make it in there. I mean, Shane, do you think, I mean, they're not profitable. So normally the S&P, that's one of their criteria, that somebody is profitable over X number of quarters. I don't know. I feel like that's a board. So they could change things. They could decide to bring it in. I don't know. But Shane, would it surprise you if it takes another year for them to get in?
No, it wouldn't surprise me. And one can make arguments for or against inclusion and why it may or may not benefit the index, why it may or may not benefit SpaceX. But I see the NASDAQ as being a more tech-heavy sort of forefront of like more aggressive growth. I mean, it's got a higher beta in theory, right? The NASDAQ does than the S&P 500. And so it doesn't surprise me that it's being included in there a little bit sooner. I thought this was a little fast, but I don't think the S&P is going to be jumping up and down to add it immediately. We'll see though. We could be wrong. And
well, I mean, the free float is an issue too. I did look at real quick. I don't know the number of shares, but the free float percentage going back to June 12th was 7.5277. So that's the percentage of shares that are free floating. And now it's up to 8.56. So it looks like some shares have joined the free float. It's something to watch, but I don't know. There was a lot of debate early on. Should it be in the indexes? Should it not? I mean, in theory, the argument against it is that you follow the process, let it do what it does, let it do what it normally does. The other side of it is, I mean, this company is going to be, I mean, from a market cap perspective, I know it's not free float cap, but it's a pretty big company. Might as well add it in. And some people say, well, why should, I mean, normally a company has to grow into qualifying for some of these indexes. And people always say, well, by the time it gets in the index, you've already had all the growth. I would argue that the growth happened during its private phase, like the valuations have jumped. So,
yeah. I mean, what is it? Main source of revenue, right, is Starlink, the space launch services. It's partnering with NASA on things, and they're doing AI computing. So it's, it's a really large company doing things that seem to be at the forefront of sort of growth investments, wouldn't you say?
Well, yes. And I think there's an interesting component here. Have you seen some of the like T-Mobile stock, some of the other wireless stocks? They haven't been doing great. And I think I read an article, I believe somebody said from the company, and I could be mistaken, that SpaceX is interested in or SpaceLink, or not SpaceLink. What's Starlink? Thank you.
Yeah.
Starlink was interested in maybe getting into the residential or cell service market. So could you imagine, because they have all the satellites, it'd be satellite-based services. I think they have a tie-in with T-Mobile where T-Mobile is using some of their satellites for, but imagine a world where, I mean, look at how complicated, and T-Mobile tried this, like John Ledger tried it, the uncarrier thing and only having one plan. I don't know. I have T-Mobile and I feel like there's 17 plans or 1,700 plans again. There's a world, though, that Starlink comes out and just makes it super clean, super easy. Here's the price. You sign up, and then you're just kind of good. Have you seen T-Mobile stock? It's not doing great. And I don't know if it's TMUS, by the way, for those of you home gamers. Is that related to something around Starlink, or is it related to just the company itself? I don't know. But it'd be kind of cool. Mike, would you sign up for a Starlink service? You have your iPhone, you're like, yeah, I'll use Starlink. Why not?
I mean, if it's cheaper, I probably wouldn't be one of the first to sign up. But
I totally would be. If it's available, I'm signing up.
Yeah, I guess I'm not sure what, if it can save costs, sure. But like, to me, cell phone services is just fine how it is right now.
Is it really? Have you looked at your bill? Have you looked at all the itemized things? It's like,
If it saves costs, that would be the big differentiator. I don't think there's any difference in carriers these days in terms of the actual coverage and, how good or bad the cell service is. But if it could save costs, I absolutely would.
Yeah, I mean, to get back to Shane's point, though, like that potentially is a revenue driver. Like, I don't know what the stock's going to do. Some people say, the TAM on this, the total addressable market, is something like, 20 trillion. Professor Aswath Damodaran would say that's crazy. That's basically, half the value of all the S&P 500 right now. We'll see. I don't know. He has a history of disrupting businesses or business lines or, industries that are disruptable. And it wouldn't surprise me if all of a sudden that becomes a big thing. I don't know what the margins are in that business. Maybe theirs would be good. Maybe it's just a loss leader and it's a way to get people to use the Starlink, the internet stuff. Because then you have the phone, you have the, and it would be your phone. I mean, I don't think they want to build phones. I think they just like you choose Verizon or AT&T or T-Mobile. Look, we gave our predictions on SpaceX. I think we're all over the board of where this thing goes. So it's going to be fun to watch, though. I can't wait for the first earnings call.
What I don't think any of us predicted was flat. And that's what it's been so far.
That's the Occam's razor pick, right? It's what the most, is it the obvious choice or the most
right?
Yeah, simplest, right?
Who's the professor who wrote Irrational Exuberance, the book? He's from Yale. Why can't I remember his name?
It is Robert Shiller.
Yeah, so Shiller, somebody years ago, they passed me this lecture, and he talks about the theory that markets are just random. And he gave this example of there's a bar, and there's somebody who's had too much to drink in the bar, and it's snowing out. And if the person, when they walk out of the door, where's the most likely spot they'll wind up if you check back in like a half hour? It's right in front of the bar. So that's the theory. That's like your Shiller theory here on randomness of markets. Like, but no, like if you bought that butterfly, the 150 butterfly, because that thing was probably cheap as heck. They're cheap because the volatility is so high that's saying it's probably going to move all over the place. We'd have to go back and see what the cost of the butterfly was. Butterfly basically pays off. If you bought the 150 butterfly and it winds up being at 150, it would pay off quite a bit, X number of times, because there's a low probability a stock is exactly where it was, 30 days earlier. So we'll have to check that. Maybe we'll look at that offline. All right, let's talk about the Fed. And new Fed chairman, Kevin Warsh, he had said little at the meeting, but one of the things he did say was he was going to appoint a bunch of committees, task forces, I think is what he said. Well, he did it. He created 5 task force. There's a productivity and jobs one. There's some professors on here, but there's some interesting, so productivity and jobs, assess the economic impact of new general purpose technologies, including AI, to inform the Federal Reserve's policy judgments. And some of the people that are on here are Mark Andreessen. There's a Stanford professor currently on leave from Anthropic, Charles Jones, and Asha Sharma, who is executive vice president of Xbox. So that's kind of interesting. You have some real world people in there. But then there's the inflation frameworks. Revisit how the Federal Reserve understands and responds to the drivers of inflation. People on that, Greg Mankiw, if anyone's ever taken an economics class, chances are you've had one of his textbooks assigned to you. Harvard University, Thomas Sargent, New York University, Nobel laureate, econ professor, and William White from the Howe Institute. So I think one of the things that he hinted on and other people have opined is going to happen is these task forces are going to look at things like how inflation is measured. And I think one of the things they're going to look at is in all this sort of impulse data or more immediate data, the Fed doesn't use that. Like a lot of the things that they use to inform policy are lagging. We know, for example, cost of home prices, those are lagging. And you'll see those coming, those will start to come down before the numbers actually show it. And they'll start to go up before the numbers show it. Remember, there's the whole owner's equivalent rent as, you know, I'm super simplifying this. Hey, Mr. Jones, what do you think your house is worth? Or, you know, or what do you think you can rent your house for? Oh, I'm paying $5,000 a month in mortgage. I think I would want to rent it for that. Okay, thanks. I'm making fun of that process, but so like if I look at this, is one of the outputs is, I'll go to you, Mike, that the Fed may adopt a whole different framework in how they measure inflation.
It's possible. I have a hard time seeing that happen sort of overnight. I think that would cause, I feel like people would think that they're moving the goalposts, right? To try to work numbers into a way that makes them more favorable or less favorable depending on the agenda. Not sure that would be the case, but the framework that they've had in place has been in place for quite a while. So I think it would be tricky to do that. But it seems like that's maybe something that he's going to try to do.
I think, but then again, why not? I mean, they overhauled. It's not like they haven't done this before. So Shane, back in the mid 80s, they changed the way they measured inflation. And, you know, you came up with these owner equivalent rents, you pull up, like they've done this before. I think the constraint, though, is can they use a new metric or a new formula, but also be able to go back and study it? So you could look at the 70s, the 80s, and actually see what it would have yielded back then. Or maybe they don't. Maybe they just say, this is broken. It's not really near-term data. So I don't know. I mean, Shane, there'll be some resistance to this, but to me, like, why not? Like, we knew we knew inflation was going up in 2021. And it was late. Like the data that came in was late, but everybody knew it was coming.
Yeah. No, I agree with that. And I think that, so like, you know, at one point, I forget, a long time back, we were looking at the GDP and like how firewood was like the majority of GDP at one point, if you were to measure it. And why I bring that up is like, you know, if you were to look at like what matters is what matters when it matters, like what's relevant, resources, what's needed, what's going on, what the next sort of economic revolution that we're going through, which seems to be a technological one, right? This AI movement, that's sort of shaping what matters and where resources are going to be allocated. And this is an evolving thing. Like, I would say this is part art, part science, part, you know, sort of math here, it's just, no one has the exact answer on what the best way to manage it is. That's why there's a team of people, a board of governors, right? And something from the minutes that stood out to me was that it was mentioned that basically almost all quote of these participants noted that it would likely be appropriate to maintain or eventually lower the target range for the Fed funds rate if in a scenario in which inflation started moving back towards 2% quickly. It then went on to note that if we find ourselves in a scenario in which inflation remains elevated due to things like strong AI-related demand, the conflict in the Middle East, or the effects of tariffs, most participants indicated that some policy firming would likely be warranted, whether it just be holding or raising. So I think that they're giving us the answer right now, and it's just a matter of how does it play out and whether they adjust how they measure inflation or not, and the effect that that has on moving it towards 2%. We'll see.
I mean, you know my position. My position is the oil. You had a raise in oil. You had a head and shoulders technical pattern. It came down to the target, breaking the head and shoulders. And if there's new hostilities in Iran, oil is not 100. Like it doesn't really. So look, they can say whatever they want, but the reality is where they think things are going to be in a year is often wrong. I'm sorry, it just is. So I'd like new ideas. In my opinion, the Fed should do less.
I do too. I think there should be less involvement, and I think that that's what Warsh thinks too.
All right, so the other thing, Mike, I know you like the boats. You love looking at the boats. Strait of Hormuz tracker. Looks like 18 ships. I don't know what date that was. People have said, well, that's not really true because some of them are turning off their transponders or they're not being tracked. I don't know any of that. All I know is Bloomberg puts out a chart. It's Econ Hormuz for anybody who has one of those. And you got this nice little chart. And basically, they used to have 140 crossings a day in the Strait of Hormuz. Recently, we got up to as many as 60 before coming back down. 18 was I guess the last one that we have. I'm not going to get into east-west or west-east. I don't know. Like a month ago, if this would have happened, oil would be higher. We'll see where it goes. I mean, to Shane's point, Mike, about inflation, it's trending in the right direction with oil. Like it's forecasted to have a minus 0.1% month over month, I think, CPI. So I don't know. Is it all about the boats?
It doesn't seem to be. I mean, I think the price of oil is telling you that either the boats don't matter as much as we think, or they expect, a return to the normal vessel count in the near future. Because like you said, if this had happened a couple months ago, or, I think oil would be back at 90 plus. But it's, the vessel count dropped a little bit. Oil spiked a bit, but, then retreated here today. And it's, if you look at, back in October, there was, 120 plus boats going in and out. Today there's 18, and oil it's higher than it was in October, but, not a ton higher like it was a couple weeks ago. So I think either the market's saying that the effect this is having on oil prices doesn't matter as much as we think, or that this is going to return to normal soon.
What's interesting is, and I just sent this to you guys, this is, I think, WTI crude oil. If you didn't know anything else and you just looked at a chart, there is a technical pattern called a head and shoulders. And that's where an asset, a price runs up, comes back down, runs up higher, runs back down, then runs up again. But the right shoulder, that right sort of hump in the chart, doesn't exceed the prior high. And then you have what's called the neckline. And you draw a target from the top to the neckline and you pretend that down. And then you draw a line to the right. And that would be the target if this actually, breaks the neckline. These pattern, I mean, some people have done research that these have about a 50% chance of playing out. I mean, if you knew nothing else, There was a classical head and shoulders technical pattern in WTI, West Texas Intermediate Crude. We reached the target. Where do we go from here? I don't know. But it's like so uncanny sometimes that price is just telling you. It's sort of telling you the story. And there's the old adage, Ralph Akinpore used to say this: does news make price, or does price make news? And his point was, if the market's unchanged, nobody says, oh, what's the news? Or the news that came out doesn't matter. But if the market really moves, it's like, oh, what's causing it? What's the news? Oh, that's why. And in the end, it's a supply and demand story. So I just thought this was interesting. I don't think any of us recognized this in real time, but pulled up the chart. I'm like, oh yeah, we had a little classical head and shoulders pattern. So yay for technical analysis. All right. Peter Maluk had tweeted something out, which I thought was interesting. And it goes to the idea of indexing or buying indexes. And he said in 1996, there were 500 companies in the S&P 500. He didn't actually say that. I'm restating that. And only 135 of the 500 constituents in the 1996 list of companies in the S&P 500 are still in the index today. It's an ever-changing index. You have companies that are the highest weighted, companies that fall out of the highest weighting. They wind up being number one, and then they're not number one anymore. So if you own the index, all that movement, like instead of trying to pick who's going to go up, who's going to go down. Yeah, I mean, you didn't have Apple wasn't in the S&P for a while until it was. But this is, I still think, Mike, this is one of the most underappreciated aspects of indexing. Not only from the fact that how much the membership of an index like the S&P 500 changes, who's in, who's out, but then the impact on earnings growth, earnings estimates. Like this is a much bigger deal than people realize, and it's an underappreciated art here.
It is, absolutely. It's passive, and so I think a lot of people think nothing changes in it because there's no one that's actively picking the stocks, but it's certainly not, stale in terms of companies coming in and out. As companies are growing and their earnings are growing, eventually you own that company in the index, and companies with less earnings or slower growth are coming out. So you're constantly, not because there's an active fund manager that says, I think the stock is going to grow in this way, but because the stock actually is growing in that direction, you're constantly getting ownership of these companies that are growing into larger companies. And then, you're eliminating the ones that have fallen back. So I think it's a huge part of why owning an index works and has worked for a long time, because you're constantly getting exposure to those.
There's people have asked me too, and we've covered this before. Shane, I think you and I covered it when Mike was out a while back, but we looked at VXF. That's Victory X-Ray Frank. It's the Vanguard Extended Markets ETF. So this is kind of like you have the 500, and then what's the next? It might be the next 1,500 largest, by market cap and weighting. And you look at the top companies in there. Like people are always like, okay, what could come in? Just because something is number one in this ETF doesn't mean it's next in line. Because I think they look at what sector it is, what subsector. For example, let's say there's a merger of two energy companies. Well, now you have one listing. You need somebody to replace the company that's now no longer because somebody bought them. So maybe they go energy. But you look at this, it's Marvell, Snowflake, Cloudflare, Bloom, Cheniere Energy, Astera Labs, Flex. You go down the line, there's different companies. So I always kind of check in on this one. And I have noticed, and I've talked to Vanguard about this, I forget what the exact methodology is, but sometimes something gets added to the S&P 500 and it's also in here for a bit. But this is kind of a nice little area to look and see what the next group of companies are. So
I like this. This is an interesting sort of like peek into that. And I think that there's something to be said. We get so caught up in just looking at the S&P 500, the Nasdaq 100, right? Um, some people still really into the Dow, I guess. I mean, we check it.
Nobody's into the Dow.
I mean, come on, it's the and the Russell from time to time, right? Which the Russell feels like it's almost more of a rates play than anything else. But there's something to be said about mid cap, and maybe not today, but at some point, like I think it's worth exploring. Like, there's some really quality names in mid cap that go sort of, I guess, underappreciated or overlooked. Just names that you don't necessarily think about or wouldn't, expect to be doing so well in stock. And it's just quality management. I think.
What's the catalyst, though? That's always the thing. Like, do you remember State Street has Elizabeth Banks? She was doing commercials for a while, and she was like, "What about the mid caps?" It was a pretty funny commercial. But I always say, because people say, "Oh, the mid caps, the forward valuations are lower than the S&P. You should buy there." And sure, that's a consideration, but sometimes you have to look at where the flow is going to come. What's going to be the catalyst to drive people into those? So, but you're not wrong. I mean, if you watch financial media, you watch CNBC, you watch Bloomberg, Fox Business, all the talk is about the big names. It's kind of like if you turn on ESPN, it's going to be the Dallas Cowboys and LeBron James and the Lakers. Like, they talk about the big names. There's a lot of companies out there. I'll give you an idea, though. If I look at the performance of VXF versus SPY over the last year, pretty similar. The extended markets was up 25.31 total return. S&P, or the SPY, which is the S&P 500 ETF, up 21.87. Okay. And, you go out, I mean, let's look at 5 years. So let me go back to 2021. And, over 5 years, you'd say, well, let me ask you guys, which one do you think? Shane, extended markets, do you think that beat the S&P, the SPY, or the other way around?
I think extended markets beat it.
Okay. What about you, Mike?
S&P.
Okay. Mike would be right. 84% total return versus 37% total return. That's 13% annualized versus 6.5% annualized.
All right. So Mike's fund is going to attract more capital than my fund.
I'm not saying that. It's just an interesting exercise, because then remember what we said earlier. Some people point out that wouldn't it be nice to own these companies as they grew big enough to get into the S&P 500? I mean, this is a big index. There's a lot of names.
But does this almost show you that while yes, like if you could, again,
but the mega caps have been killing it. We know that. U.S. large cap has been killing it.
The leap from mid cap to large cap isn't as great as what the leap can be once you are a large cap company, I guess, is sort of what this is showing.
Yeah. Or if you don't pick the ones that make it, it drags too much on the ones that do eventually exit.
Yeah, I mean, but there are times too. I mean, people say buy international because it's so cheap, and U.S. large cap outperforms for decades. Now, international has had its day last, I'd say, year and a half. It's done pretty darn good. So, all right. I mean, we'll look at mid caps. Okay, that's fair enough. Look at the forgotten mid caps. Are mid caps like the middle child? Is that kind of how you look at those?
Yeah. Yeah, that makes sense. They've got enough to survive, and they're sort of established, and at the same time, like, they're not too exciting to be with the bigger boys.
But you know what the difference is nowadays is in the old days, and even when I say old days, I'm thinking 80s, 90s, there were companies who came public much earlier, and they came public much younger. SpaceX just came public at a $2 trillion valuation. I mean, in the past, historically, a company like that would have done a little bit of private funding, maybe not as much, and they would have gone to the capital markets. Would have been a small cap, then a mid cap, then a larger, and then finally they get in. They sort of work their way up if they're around. That doesn't happen now. Like, these companies are staying public. In the next 6 months, my guess is we have Anthropic and we have OpenAI. I mean, they both secretly, quote unquote, filed for their, filed their S1, although everybody knows they did it. I guess they filed it. It's not secret. They told everybody they filed, but you can't look at it yet. So,
would you argue, like, so you're describing companies that are posing potential disruption to existing other companies, other areas of the market, taking over market share of certain areas. Wouldn't you argue that, like, it's beneficial for those invested in the market and the marketplace in general for these companies that pose this potential disruption capability to be public and available for people to invest in openly? Because otherwise, if these were privatized companies that then absorb market share out of the public market, that would actually have a drain on investors, right? Like, I think BlackRock, Larry Fink, and other people have talked about this. Like they're going to make sure this stuff is stuff that can be invested in if it's going to
I don't know. I think there's also the argument that, so people say that, and sure, if there was money that was otherwise going to go in public markets, it goes into private placements or venture capital funds. But then when SpaceX comes public, when people are out of the lockup, if they want to diversify, sure, they can go back into more private stuff. But who's to say more that a lot of that money doesn't wind up in public markets?
Right.
And so it's a delayed effect. I mean, Mike, I know you were a very early investor in SpaceX. I think your cost basis is a penny. You're going to diversify out of that, right? I'm kidding, folks. I'm kidding. He's not an early investor.
I would be just trying to buy puts to protect. Not because I think it's going to go down, but that would be a long wait. I don't know if you're locked up, if you even can do anything like that. But
yeah, my guess is we start to see, and maybe we'll see it, who knows, where people have shares, low basis, and we wind up doing hedging on it. Maybe we do, a box trade loan to access liquidity because it's better taking a loan against the shares. My guess is there's going to be some of that's coming out, but we'll see.
Are there leveraged funds out on it yet? Have we got QXs, right?
Oh yeah.
Yeah.
Yeah. There are leverage funds. Of course there are. Why not? Why wouldn't there be leverage funds?
They can be made, so they are.
I wonder if anybody's filed yet for a leveraged Anthropic ETF. Because they're coming public.
Yeah. If anybody's like, do you have the ability to do that? Can you be waitlisted for something pre-IPO?
Mike, do you know that? I don't know if it has to be. Okay, tell us.
I see that some people have already filed for 2x leveraged Anthropic ETFs.
Wow.
Really? Okay. I'm
Rec
sure there's
shares
some
and Tuttle Capital. I'm showing.
Yeah, so they're already.
That's neat. Maybe that's a tell in terms of what to expect coming out for future IPOs. Maybe you can look at names that have filed for that. You can keep an eye on it. I wonder.
If you want to do that, you go for it. That seems like a lot of busy work.
Yeah, I'll be up late at night track.
Yeah. Well, part of the reason why funds want to file is because there's first mover advantage. So you can imagine if your fund's the only one available when it starts trading or options start trading. I mean, I guess you can use swaps beforehand, but yeah, I mean, you get the flows, people get familiar with it. There's liquidity in it, but it doesn't surprise me that stuff. I can't wait for Anthropic's S1. I can't wait for any of these. I couldn't wait for SpaceX's because it's your first chance of seeing the financials. So, all right. We're not going to talk about Bitcoin or MicroStrategies or strategy this week. I'm sorry. Crossing it off the list. So I'm vetoing any talk of that. We talked about it enough for the last couple of weeks. We do get emails though, and people reaching out when we talk about it. It seems to be a hot button. Let's see. I got to be honest though. Does it feel like the S&P is in the summer doldrums? I mean, we've had some volatility. I mean, the market's it's not at its all-time high. It's come off. I think feels a little meanderish, Mike, and maybe that's okay.
Yeah, it does. It feels like it's wants to trade sideways for a while. And as soon as we say that, it's going to break out one way or another. But the way it's looking, yeah, it's doesn't seem like it wants to make new highs. It's, when it does sell off, it seems to come back pretty quickly. So it does feel like, 0.5% up or down is sort of what we've been seeing the last, I don't know, couple weeks.
I mean, you look at, like Shane, we were talking about earnings. The market's in a little bit of an information void right now. Sure, we always have the geopolitical stuff. We got the Fed stuff. But earnings are coming, and we're about to get the onslaught of earnings. Earnings estimates are still good. Like, earnings estimates are pretty solid. I think earnings estimates have gone up. So everyone, Shane, we always say like, oh, this is going to be the most important one. And sometimes it's flat, and the expectations for volatility aren't there. But I don't know. We'll probably hear stuff about cash flows. We'll probably hear stuff about CapEx. There was a chart from B of A Research, and I know, Shane, you've been on this. I'll put this in our chat so you guys can see this. And it is a generational, this is titled, A Generational Transfer in Free Cash Flow is Taking Place. 12-month forward free cash flow of hyperscalers and semiconductor companies in billions. And for the audience who can't see this, hyperscalers is going down, semiconductor companies are going up. So basically what this is saying, Shane, is free cash is going from the hyperscalers to the semis. But I guess people own this stuff. I mean, they own everything in the S&P.
Yeah. And I mean, I think that something came out today, like alongside this, which I saw this chart that you just sent elsewhere too. Great chart. Thank you for the nod there.
Wasn't mine, but I'll take credit for it. Thank you. Yep.
But Meta, did you see the announcement this morning? Meta's this is according to CNBC, Meta to put AI chip into production in September as it looks to double computing capacity. So I believe AVGO and Taiwan Semiconductors, Broadcom and Taiwan Semiconductors, are involved in the designing and manufacturing of the chip. And it is intended to help the firm lower its massive computing costs and gain more independence from chip suppliers such as NVIDIA and AMD. So maybe there's your tell. Who knows, right? We're going to see in the coming months and years how this plays out. I don't think NVIDIA or AMD will just magically become irrelevant. But look, you lived through it in the 2000s. You saw with Cisco what happened there. And I'm not saying it's the same thing over again. Who knows? But Meta deciding to do that, announces that this morning, and then the stock's up 4.7% on the day. Back up to its highest level that it's been to since June 4th. So highest level in a month. I think that might be a tell. We'll see.
I can't figure out what Meta's doing.
Maybe they can't either. Who knows?
I mean, it's like they figured out the algorithms on Facebook and how to do online advertising. I think that's probably, the number one company when it comes to figuring that stuff out. They also have Instagram. People use Instagram. I feel like they're always buying stuff off Instagram. They see a pair of boots on Instagram and they buy them. They see a shirt, a suit, they're buying it. And my guess is they're getting a piece of that, or at least getting the advertising revenue. I can't figure out what they're doing. I don't know. Like, do they have a cloud service? I should look at that.
I think so. And like, Mike, have you seen, or I mean, either of you, have you guys seen the Meta glasses? And like,
who's going to do those? That's a ridiculous idea.
To me, it's less about, I think, being a successful product, and I think there's data to be gathered for AI training there. But that's what I'm waiting on. Is there's some algorithm stuff, some cloud computing, or something going on behind the scenes? Maybe even quantum computing they jump into. I don't know, but to me, more than anything, the market seemed to love the idea that Meta is going to break away its dependence on this sort of small list of potential providers of these chips and start manufacturing their own using Broadcom for the design, like we said, and Taiwan Semiconductors for the actual manufacturing of it. So,
look, Apple solved their own chips. I mean, Apple makes their own. I mean, I don't know how much they're actually doing it versus white labeling for people. I think Taiwan Semi makes some of theirs. So, all right, we'll see what happens. I kind of laugh at Meta because I feel like they're always getting into different business lines, and they figured out the advertising. All right, Mike, you have any recommendations this week?
I do. House of the Dragon.
Okay.
It's in its third season. It's like a Game of Thrones spinoff. Takes place well before Game of Thrones, and it's been pretty good. It's not as good as Game of Thrones, but every season has gotten better. So this is definitely the best so far. I think there's going to be 4 seasons total. So if you're a Game of Thrones fan, I recommend it.
Okay. All right. It's tough. Like, I watched Game of Thrones. I haven't gotten into any of the other series. I feel like there was a lot of episodes. I watched it late. I had to catch up a lot of episodes, so I haven't gotten to it. But okay, it's on your recommendation list. That's fair enough.
Yep.
Shane, what about you?
So, it's recently started Lioness. It's on HBO. It's about essentially a female-led group of CIA operatives, and it's a little rough. It's on Paramount, but so far I'm like 2-3 episodes in here. It's been good. It's been interesting. I didn't watch like Blacklist all the way through, but it gives me like, it's a little bit like that. There's the espionage and sort of, again, the game theory going on, but I'd give it a buy so far.
Oh, it's a buy, not a strong buy. A buy. Okay, that's fair enough. For me, I don't remember if I recommended the last season of The Bear yet. If I haven't, I'll double down on it. So that's a strong buy for me. It's on my conviction list. As I think Goldman Sachs, they used to call it a conviction list. Last season of The Bear, I think they landed the plane and tied everything up together. The story arc makes sense, and so it's look, the acting, the dialogue, it's all great. So The Bear, I think we have talked about this, but I finished it, so it's pretty solid. So there you go. All right, we did it. And do we have our World Cup pick? Like, to me, I think Argentina is going to win, even though they've been a little shaky because they have Messi.
Agreed. After they came back the other day, I said I think they're winning it all.
It was a little controversial. I think they looked at fouls from 2 weeks ago too in that game, and changed those. It's a little controversial. It was that assessing that foul on that goal, but
I'm gonna say, you guys are gonna think I'm nuts. I'm gonna say Morocco. I'm gonna say Morocco upsets France, and then rolls through the winner of Spain or Belgium.
France would not like that.
I know they wouldn't. And then I think Morocco plays likely Argentina. I'm really looking forward to the Norway and England game, just because I feel like that's going to be
All these games could be done, by the way. I haven't even checked the schedule by the time this is out.
Saturday.
Oh, okay. So everyone will just see how bad of predictors we are on the World Cup. All right. Yeah, like it's been good. The U.S. games stunk. They didn't.
They played. France and Morocco already played, and Morocco lost. So there you go. See.
So yeah, thanks for that recommendation. All right, we shouldn't even talk about this. All right, guys, we did it. We're done. We'll come back next week and see everything we got right and mostly wrong. For everyone else, we'll talk to you soon.